Okay, thank you, everybody. Welcome to today, Saturday, the 6th of March, 2021, which is going to be day 15 of our program, okay? And we'll be having one or two discussions on where we stopped in the last class. And there is a task that we gave ourselves in the last class. And I believe many of us are able to do the task. And the task is what I've shared on the screen. Can you acknowledge that you've done the task? And can you tell us one or two things that you find interesting or otherwise? The floor is open for you guys before we move to the order of the day.
Good afternoon, everybody.
Good afternoon.
Yeah, I actually attempted the task and it went fine. But what I discovered, the principle that I noticed that was tested in this task is number one, it is mid-year acquisition. It is mid-year acquisition, and the pre-acquisition reserve needs to be dealt with carefully. Apart from that, I noticed that the non-controlling interest was treated using fair value principle. I mean, fair value approach. And those are the key things. But when I did it, I assume I got it right.
I like that phrase, you assume you got it right. Okay.
Thank you.
Yeah. Who else? Who else? The floor is open. I'm waiting. Contribution. Shegun, did you attempt it?
Unfortunately, I did not have time to attempt it.
Why? No time? Enaru, did you try?
Yeah, I didn't try. There was no time. I just wanted to start doing it this morning, but
And there's no time between last week and now?
yes, I get home late these days.
Okay. Okay, let me try and share something with you. Nuruddin.
Yes, sir.
You said you are not sure whether you got it right or not.
But I can share my screen to show what I actually did.
Okay, can you share your screen?
Okay. Sorry, I need access.
Okay, let me stop sharing my screen. Okay, try and share it now.
Okay, this is what I did. Here is my working sheet.
Okay.
This is the group structure. ENSCO have a 80% appreciation, while my non-controlling interest is 20%. Okay, my date of commencement is 1st January 20x5. My date of consolidation is 1st of December 20x5. My date of acquisition is 1st of April 20x5. Okay. Okay. My pre-acquisition reserve, that's what I dealt with. From the question, the pre-acquisition reserve for I want to remember the name of the second, the name of the subsidiary.
The subsidiary is Sync.
Okay, Singe. Okay. Pre-acquisition reserve for Singe as at 1st of April. Sorry, as at 1st January 20x5 was $15,000. And this is what I recognized here. Now I discovered that the reserve profits during the year from 1st January to 20x5 to 31st December 20x5 sum up to $18,000. Meanwhile, since the acquisition took place during the year, I tried to prorate the profits that was gained during the year, which the total profit was $24,000. Okay, but since I noticed that my the acquisition took place on 1st of April 20x5, I tried to prorate the profits during the year using 3/12 because I discovered that 3 months has been the operation has gone for 3 months before the acquisition took place. Okay, that's why that's form part of my pre-acquisition profit. That's why I prorated 24,000 to be 3/12 of 24,000, which gave me 6,000. That's why I recognize 6,000 here. I added that 6,000 with my pre-acquisition reserve, which gave me 21,000 as a reserve as at 1st of April 20x5. Okay, my post-acquisition reserve, I did the same thing by doing 9/12 of 24,000, which is the profit during the year. I mean, 24,000 was the profit during the year. I prorated it to be 9/12, which is 9 months, which serve as the post-acquisition reserve. That's how I arrive at 18,000. Okay. I tried to determine my goodwill. The cost of combination investments in Singe happened to be $50,000. Okay, then I valued my NCI. This is my computation for the valuation of NCI measurements. I have for Singe, I have equity to be 10,000, that at 50 cents. That's why I use 10,000 divided by 50 cents. Then I multiply it by the fair value, the fair share price of Singe as at the period. That's how I arrive at 50,000 here to be the value of NCI. Then to be the value for for subsidiary. Meanwhile, since my NCI is 20%, I took 20% of $50,000, which gave me 10,000 as my NCI. Okay, now I moved to determination of goodwill. My investment in Sage is 50,000. Now my NCI at fair value now gave me 10,000. Okay, when I sum up the two, I have 60,000. Now I went further to do my identifiable net assets as at the date of acquisition. Okay, the equity of subsidiary was 10,000. Then reserve as at date of acquisition, which I computed up here, gave me 21,000. And I used 21,000 for my reserve. I used 21,000 for my reserve. Then the share premium as at the date of acquisition for the subsidiary also stood at $4,000. I sum up everything to be my identifiable net assets, which results into $35,000. I subtracted it from the cost of combination, which gave me $25,000 as my goodwill. Okay, after that, I computed my consolidated reserve as at date of consolidation. Reserve for Inch. Okay, reserve for Inch Co in the statement of financial position was 40,000. Therefore, I have share of post-acquisition reserve, which is 80% of my post-acquisition reserve, which stood at 18,000. I took 80% of 18,000, which gave me 14,400. Yeah, I proceeded by doing my non-controlling interest as at a consolidation date. Then my balance brought forward for NCI, meaning the NCI as at acquisition was 10,000 as shown in my computation here. NCI, yes, 10,000 for my NCI. Then I share post-acquisition reserve for NCI too, which is 20% of the reserve, which I got 20% of 18,000. That gave me $3,600. My NCI as at date of consolidation stood at 13,600. Then I proceeded to do my group consolidated statement of financial position. And I have my PPE to be 32,000 plus 30,000, which gave me 62,000. My goodwill, I brought it forward to be 25,000, which I got when I determined goodwill. Then I recognize my current assets, which is 85,000 plus 43,000, which sum up to 128,000. The total assets now give me $215,000. Okay, for equity and liability, I recognize equity share attributable to Int'l. This was given in the question as $100,000. Then the share premium was also given in the question to be $7,000. Now I recognize my reserve, which I computed here as post-acquisition reserve. Consolidated reserve, which is 54,400. This is it. That gave me my equity attributable to parents, which is Int'l. Equity attributable to Int'l stood at 161,400. Then I recognize my equity attributable to NCI, which is 13,600 as computed for NCI. Here, 13,600. Now that gave me my total equity to be 175,000. Then I recognize the current liability, which is 20,000 plus 20,000, which gave me 40,000. The total now resulted into 215,000 as total equity and liability. Thank you.
Thank you very much. I don't think I can even do better in giving this narrative. You've done more than justice to this, and I think it is about time I handed over the remaining program, at least if not the remaining program to the end, but for today to you to continue.
I'm not up to task.
Yeah, no, I'm highly impressed. I'm not only highly impressed that you got it right, the ability for you to explain step by step, and the ability of you to make use of Excel rather than me using analog writing, you understand? But again, I really appreciate. Let us now compare with what you, because you are saying you are not sure whether you are right, but let us look at it whether you are right. People in the house, is it right? It's as if his own will be used as marking scheme. Is that not?
Yeah, well done, Norudo. Very good.
Yes.
Yeah. I'm highly impressed. Thank you very much. And you have done the job I'm supposed to do today. Therefore, thank you very much. Therefore, we can now proceed to the discussion we want to have today. And I'm going to share this screen with you. I believe some of you have the text. And Mr. Shegun have delivered the text to Peter, who's going to hand over to it in France.
Yeah.
Okay. Thank you
very much.
Your network is poor.
Oh, I said you already notified me.
Okay. Can we continue? Hello. I think I had a poor network at the time. Can you hear me now?
Yes.
Yes, sir.
Okay, thank you. Okay, now let's move to the discussion today. It's going to be on fair value of subsidiaries, identifiable assets and liabilities at the point of acquisition. Now, what does that mean? IFRS 3 requires us to carry out fair value measurement for every asset and liabilities identified as resources controlled by the business in which you have acquired and the liability assumed by those businesses as identifiable, whether they are in the books or not. All identifiable assets and liabilities have to be recognized upon acquisition at the acquisition date fair value. Now, at this early stage or elementary stage, we approximate fair value to equal the market value of the business. Okay, even though when we get to financial instruments and we get to fair value measurement under IFRS 13, we discussed on hierarchies to which fair value can be ascertained. But at this level, we are picking the highest hierarchy level for fair value, which are quoted market prices of instruments. Now, the instrument in contention here are shares, ordinary shares that give residual interest ownership. And on that premise, I want to put it to us as professionals to ask ourselves, though we know and we appreciate that IFRS 3 requires us to measure assets and liabilities acquired in a business combination at acquisition date fair value. What is the rationale for it? Why can't we make use of the carrying amount of assets and liabilities as reported in the books of the company and as certified by auditors as the value of the business? Why measure these acquired assets and liabilities at acquisition date fair value? The floor is open. We need to extensively discuss that, agree our position, and move on from there. The floor is open. I can't hear anyone talk. I think I'll call him. Let me start with Madam Grace. Madam Grace, we want to hear from your wealth of experience. Why should we measure acquired assets and liabilities at fair value when we acquire a business? Madam Grace, we can't hear you. Okay, let me put it to Enauru.
So why we need to measure the net asset using fair value on acquisition? I think my own understanding is that I think the IES is moving towards more of the ISB is moving towards fair value for instead of historical costs. So I think the ISB believes that the fair value is more realistic and is more up to date as vis-a-vis the historical value, which is more or less the book value. So I think the fair value is more up to date, and I think that and the fact that they are moving towards this fair value for as the cost of assets. That is my little understanding of that. I hope you heard me.
Yes,
Hello?
Who else? Who else? Miriam.
I don't have an idea.
Okay, if I can just say something. Yeah, you told us earlier that we should assume that fair value is the same as market value. So I believe fair value represents what the market expects of the asset. For instance, now maybe the company wants to dispose of the assets at some point. The person buying it, we want to negotiate at what the market says, what a knowledgeable person about the asset we want to pay for such an asset. So, and it's only objective to recognize such assets at the prevailing market value, what the actual amount that a knowledgeable person about the asset will want to pay for it, than to recognize it at the historical value. Because if we should recognize it as at the historical value is like we are either overstating or understating the value of the assets.
Okay, thank you. Who else?
In addition to what Segun's just explained now, I have the same notion with his explanation. Actually, fair value is more realistic as we say, compared to carrying amount. And the reason for this should be that carrying amount is based on accounting principle, and entities use different approach to value their assets. However, fair value is the market value of assets and liability, and it should be more realistic and reliable to measure the assets and liability. That is my submission.
Okay. Asama.
Okay, I agree with what Segun and Nuruddin has said, but maybe I can say it in another way. So I think fair value should be used, should be measured at the point of acquisition, so that the amount in the books is not either overstated or understated at the point of acquisition. Because by definition, or the assumption, by definition, fair value being market value represent the amount, the fair amount that that we can state the asset of the business at the point of acquisition.
Okay, Olawale, welcome. Are you there? Okay, if not, Anayo, are you there? Okay, let's forge ahead. Now, you guys have provided different rhetorics. And I believe when we combine everything together, we seem to have answered the two questions. But let me summarize it as all. The requirement of the standard is this. The starting point of estimating the current value of a business that has been acquired is for you to more or less identify what are the assets and liabilities the business have within its custody. By way of asset, what does it control? By way of liability, what obligation does it assume? Now, in doing so, our first point of call is to obtain the books of the business. And obtaining the books of the business, even if we assume that all is correct, by way of due diligence, one thing that is essential for us to do is that the books usually reflect the carrying amount of assets and liabilities, of which there are various accounting measures adopted for different kinds of assets and liabilities. If you go by way of the conceptual framework, the measurement bases adopted or proposed by the conceptual framework are two: the historical cost and the current value. The current value itself has about three methods under it: the fair value, the present value, which deals with value in use for an asset and fulfillment value for liabilities, and the current cost. What that means that assets and liabilities in the books is going to be recorded as a mix of the underlisted historical cost, fair value, present value, and current costs. And what that means that if we agree that fair value, present value, and current costs are very close to what we can consider as the current prices or current value of assets and liabilities as at the acquisition date. But certain measurement is far apart from that, and which is historical cost. What that means that at least we have one or two categories of assets or asset classes that may not have been reflected at their current values. Rather, they are reflected at historical cost, which is far apart in most instances from what the current prices are. And when we ask ourselves a simple question, if you are the original owner of a business that has a landed property, and in the books, your accounting policy is to carry such a landed property at cost. 10 years ago, that landed property was bought for 10 million. And in your books 10 years after, the landed property is still carried at 10 million. It's not depreciated because it's asset of indefinite life. And it has not been measured at value amount because your policy is to carry at cost. Now, the question then is, if we go by way of your book value or your carrying amount, the entire value of the business will have been understated. I think grossly understated. Given that even if you strip the land alone and try to sell and retain your business, I believe you can't sell that land for 10 million. Probably today, the land is going for 50 million. The question then is your carrying amount a true reflection of your current value of your asset and liabilities? The answer is no. Therefore, a rational seller will always want to sell at what is profitable at the marketplace. Therefore, the question then is, the consideration you pay is not only paid for what the asset value is in your books, but is paid to reflect and capture what the current prices of those assets and liabilities are in the market. And on that premise, IFRS 3 requires that at every point of acquisition, acquired assets and liabilities as identifiable should be measured at fair value, which means all assets and liabilities will be measured at fair value, but not necessarily will all result in a fair value adjustment. What is a fair value adjustment? It is a differential between what the fair value is and what the carrying amount was. Which means if the fair value is 10 naira and the carrying amount is 8 naira, the adjustment is to write up your asset by 2 naira. If the fair value adjustment, if the fair value of the asset is 10 and the carrying amount is 13, it means you need to write down the value of the assets by 3. The 3 represents your fair value adjustment. Okay, this fair value adjustment is going to be required only when there's a material difference between the fair value and the carrying amount. And usually there is a material difference if the asset you are talking about or the liability you are talking about are carried at cost, rather than those that may have been measured at present value, current cost, or at fair value. While minimal adjustment may be required for those assets and liabilities that are measured at fair value already, or those that are measured at present value, or those that are measured at current cost. And that summarizes all of it all. Any question at this point? Any question at this point? Okay, I want Marian to help us buttress this by reading this to us. And let's use it to substantiate what I've discussed and the contribution everyone has made in this in the course of this discussion. Over to you, Maria.
Fair value and business combinations. IFRS 3 requires the cost of investment and the identifiable assets and liabilities of the subsidiary be measured at the fair value upon acquisition of the acquiree of subsidiary. It has been observed over time that the book value carrying amount of the subsidiary's net assets as at acquisition do vary from the fair value of the identifiable assets and liabilities as at acquisition date. The rationale for the net assets valued or remeasured at fair value at the date, including unrealized earnings, that is profits of the date of acquisition, and to prevent distortion of earnings per share in periods subsequent to or after the acquisition. This makes it a necessity to revalue the identifiable assets and liabilities of the subsidiary prior to consolidation as at the date of acquisition. It is equally necessary to note that the parent's assets and liabilities remain unchanged at book value, that is carrying amounts as presented in valued at acquisition dates, while it is only the subsidiary's position, assets and liabilities that are to be fair value and adjusted for the purpose of the presenting consolidated accounts. IFRS 3 sets out general principles for arriving at the fair value of subsidiaries' identifiable assets and liabilities. The parents should recognize the subsidiaries' identifiable assets, liabilities, and contingent liabilities at the acquisition date if the following criteria exist. A, in the case of an asset other than an intangible asset, it is probable that any associated future economic benefits will flow to the acquirer, and its fair value can be measured reliably. B, in the case of a liability other than contingent liability, it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and its fair value can be measured reliably. C, in the case of an intangible asset or a contingent liability, its fair value can be measured reliably. Technical notes. The subsidiary's identifiable assets and liabilities might include assets and liabilities not previously recognized in the subsidiary's financial statement. The fair value adjustment carried out upon acquisition of the subsidiary is considered as an adjustment to pre-acquisition reserves, which implies that prior to acquisition, the value inherent in the subsidiary and has surfaced and recaptured on the acquisition should be considered in determining the amount of goodwill on acquisition or gain from a bargain purchase transaction. It is worthy to note that fair value adjustments carried out subsequent to acquisition cannot be retrospectively applied or considered as an adjustment to pre-acquisition reserves. As such, fair value adjustments were subsequent to economic and market effects and fundamentals of the subsidiary since acquisition, and in such case, it is considered an adjustment to post-acquisition reserves, which should be included in the consolidated reserves. In calculating goodwill arising on consolidation or gain from a bargain purchase, the net assets of the subsidiary should be restated at its fair value, and there exist two possible ways of achieving this. One, the subsidiary might have incorporated all necessary fair value adjustments in its financial statement, as its accounting policies may support measurement at fair value, such as financial instruments, biological assets, investment properties, some components of property, plant and equipment, etc. In this case, we may consolidate directly as the assets and liabilities have been restated at fair value and prerequisite adjustments have been effected. Okay. B, the fair value adjustment may be required as a consolidation adjustment without being incorporated in the subsidiary's financial statement. In this scenario, we need to make all necessary adjustments at the point of consolidation, that is upon preparing the group accounts. Accounting treatment of fair value in a business combination. The parents should recognize separately at the acquisition date fair value the acquirees for subsidiaries' identifiable assets, liabilities, and contingent liabilities only if they satisfy the following criteria at that date. 1. For an asset other than an intangible asset, it is probable that any associated future economic benefits will flow to the acquirer and its fair value can be measured reliable. 2. For a liability other than a contingent liability, it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation and its fair value can be measured reliable. 3. In the case of an intangible asset or a contingent liability, its fair value can be measured reliably. Identifiable assets and liabilities recognized in the account are those of the acquired entity that existed at the acquisition date. The following specifically do not meet the criteria listed above and therefore must be dealt with as post-acquisition items. 1. Changes resulting from the acquirer's, that is, or parents, intentions or future actions. 2. Changes resulting from post-acquisition events. 3. Provisions for future operating losses or reorganization costs incurred as a result of acquisition. Restructuring and future losses. An acquirer should not recognize liabilities for future losses or other costs expected to be incurred as a result of the business combination. IFRS 3 explains that a plan to restructure a subsidiary following an acquisition is not a present obligation of the acquirer. I'm sorry, can you increase this? It's too, I can't see it properly. Okay. Restructuring and future losses. An acquirer should not recognize liabilities for future losses or other costs expected to be incurred as a result of the business combination. IFRS 3 explains that a plan to restructure a subsidiary following an acquisition is not a present obligation of the acquirer at the acquisition date. Neither does it meet the definition of a contingent liability. Therefore, an acquirer should not recognize a liability for such a restructuring plan as part of allocating the cost of the combination unless the subsidiary was already committed to the plan before the acquisition. This prevents creative accounting. An acquirer cannot set up a provision for restructuring or future losses of a subsidiary and then release this to the profit or loss in subsequent periods in order to reduce losses or smooth profits. Intangible assets. The acquirer may have intangible assets such as development expenditure. This can be recognized separately from goodwill only if they are identifiable. An intangible asset is identifiable only if it, 1, is separable, that is capable of being separated or divided from the entity and sold, transferred or exchanged either individually or together with a related contract, asset or liability, or B, arises from contractual or other legal rights. Done with that page. The acquirer may also have internally generated assets such as brand names, which have not been recognized as intangible assets. As the acquiring company is giving valuable consideration for these assets, they are now recognized as assets in the consolidated financial statement. Contingent liabilities. Contingent liabilities of the acquirer are recognized if their fair value can be measured reliably. This is a departure from the normal rules in IAS 37. Contingent liabilities are not normally recognized, but only disclosed. After their initial recognition, the acquirer should measure contingent liabilities that are recognized separately at the higher of A, the amount that would be recognized in accordance with IAS 37, B, the amount initially recognized. Let's continue.
You are meant to continue.
Okay, sorry. Determination of fair value upon acquisition of a subsidiary. IFRS 3 requires that the identifiable assets, liabilities, and contingent liabilities acquired, which will be recognized, should be those of the acquirer, that is subsidiary, that existed at the date of acquisition. Liabilities that should be recognized should be assumed existing and absorbed under acquisition, and not those resulting from the acquirer's intentions or actions. This implies that liabilities for terminating or reducing the activities of the acquiree should only be recognized where the acquiree has, at the acquisition date, an existing liability for restructuring recognized in accordance with IAS 37, provisions, contingent liabilities, and contingent assets. Furthermore, liabilities should not be recognized for future losses or other costs expected to be incurred as a result of the acquisition, whether they relate to the acquirer or acquiree. What is fair value? IFRS 13 defines what a fair value is and also expatiates on the sources of obtaining fair value vis-a-vis the hierarchy of fair value measurements. Fair value, the price that will be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. IFRS 13 provides far-reaching guidance on how the fair value of assets and liabilities should be ascertained. This standard requires that the following are considered in determining fair value. A, the asset or liability being measured. B, the principal market, that's where the most activity takes place, or where there is no principal market, the most advantageous market, that is, that in which the best price could be achieved, in which an orderly transaction will take place for the asset or liability. C, the highest and best use of the asset or liability, and whether it is used on a standalone basis or in conjunction with other assets or liabilities. D, assumptions that market participants would use when pricing the asset or liability. IFRS 13 provides a hierarchy of inputs for arriving at fair value. Okay, so for the hierarchy, there is level 1, level 2, level 3. Level 1 states quoted prices in active markets for identical assets that the entity can assess at the measurement date. Level 2, inputs other than quoted prices that are directly or indirectly observable for the assets. Level 3, unobservable inputs for the assets. Technical notes, it requires that level 1 input is used where possible. We are to consider the above identified scenarios with simple illustrations. Okay.
Thank you very much. Thank you very much. And I believe if you are in spirit and you are in the realm with our readings, you will find out that everything we've discussed today, both the one contributed by participants and the one summarized by me, has already been captured by this reading. Okay, now we want to demonstrate what it is by carrying out fair value adjustments. Now to do that, I'm going to take us through this. Okay, I'm going to look at scenario B. Okay. Okay, this is scenario B. Now, this scenario B will expose us to what we need to do with respect to how do we carry out fair value adjustments, and how does that adjustment, how is it reflected in the books, and how does that affect the measurement of goodwill or gain arising from a bargain purchase transaction. Any question at this point before we forge ahead? Any question at this point? The floor is open. Any question at this point? Okay, if there's no question, now let's try to read this exercise, which I've copied into our notes. Probably I'll copy it here in a fresh sheet. Okay. Who can I call to volunteer to read the question? And now, can you read this question for us and let us attempt solving it based on the little discussion we've had? Can you unmute?
Okay, can you hear me now?
Yeah, we can.
Okay, illustration 2. Pali PLC acquired 80% of the equity share capital of Suzy PLC on the reporting date 31st December 2015. At the date of acquisition, the fair value of Suzy PLC plant was 150 million naira, whereas the carry amount, the book value of other assets and liabilities, equal the fair value upon acquisition. The statement of financial position of the two companies on this date stood as follows. Statement of financial position as of 31st December 2015. In millions of naira. Plant, Pali 300, Suzy 130. Investment in Suzy PLC. Under Pali 200. Current assets under Pali 120, under Suzy 70. Share capital and reserves. Equity share capital at 1 naira per share. Under Pali 400, under Suzy 120. Reserves, retained earnings. Under Pali 140, under Suzy 60. Total share capital reserve 540 under Pali, 180 under Suzy. Current liabilities under Pali 80, under Suzy 20. So total share capital and current liability is 620 under Pali and 200 under Suzy. Assuming the prevailing market price of Suzy share prior to the date of acquisition is 2 naira per share. So I think there's no question there. So we take it up.
Okay. Okay. Can you hear me?
Yes.
Okay. Thank you.
Yes,
Thank you for reading the question. Thank you for reading the question.
Okay,
Now, where does the principle lie? Everything we want to discuss now, the dynamics lie within this phrase. At the date of acquisition, the fair value of Suzy's plant was 150 million. Whereas the carrying amount or the book value of other assets and liabilities equal the fair value upon acquisition. Who can interpret this statement?
Okay, let me try. The statement implies that the current amount of the identifiable assets and liability in the books is the same as the fair value when they determine the market value of the identifiable net assets and liability. Thank you.
Who else can contribute?
Okay, if I may just add to that, that implies that in this scenario, there won't be need for any form of fair value adjustment as the book value is already the same as the market value of the assets, of the identifiable net assets.
Okay, who else can contribute further? Marian.
I think it's just as they've said, the fair value is same as the book value of the identifiable assets upon acquisition.
Okay, now I think you guys have said it all. What it simply means is that when we pick plant, we find out that the fair value, these are the carrying value. Everything here are the carrying value. Now, when we determine the fair value, when we did the fair value, we found out that this 130 as at 31st of December 2015 was 150 based on market price. We did for current assets. We found out that the current asset is carrying amount is 70 and equally the fair value is 70, which means this is 220. Share capital. We discovered that the carrying amount was 120 and the fair value still remain at what? 120. Reserve is reserve. This is residual. The fair value will always be the same, 180. We have current liability. Upon fair valuing it, we discover that both the carrying amount and fair value remain at what? 20. But when you check it, what do we have here? We have 200. Therefore, if you check this, the balance sheet failed to agree with this. Who can tell me what has gone wrong here? Who can tell me what has gone wrong and what do we need to do?
I think the equity side, for me, there should be a fair value reserve in the equity of Suzy that will take in the fair value gain of 200 on plants, which has been taken. Fair value gain and fair value has been recognized on the asset side, but on the equity side it has not been recognized. So there should be a fair value reserve for that of 20 million.
Okay, thank you. What it means is that, okay, let us identify the fair value adjustments. When we check everything, you find out that the only one that requires an adjustment is the one I'm highlighting. And why? Because others have the kind amount and fair value to be what? Equal. Now, what that means, I will now come here to say, the only fair value adjustment I have is with respect to item of property, plant, and what? Equipment, which has a fair value of 150, which is as at acquisition what? Date. And the carrying amount of 130, the difference being 20. And this 20 is a form of fair value gain. And a fair value gain should affect our reserve. And what that means that this 60 here has a question mark. It's no longer 60, but it should be what? 60 plus the 20, which means this is what? 80. By the time this is 80, this will become 200, and this will become what? 220. Does that make sense? Does that make sense now?
Yes.
Okay, now what are we trying to prove? It's going to lead us to something that fair value adjustment will impact your reserve. Fair value adjustment will be part of your what? Your reserve as at the date of acquisition. Which then means that at the end of the day, given the group structure, what's the name of the company? Pali? And Susie. 80% stake. NCI is 20% stake. Date of acquisition was 31st of December 2015. And we are reporting 34th December 2015, which means we are still on that spot. Now, how do we determine our goodwill, if any? We'll look at the two options, option A and B. Who can remind me what option A and B stands for? Who can remind me what option A and B stands for?
I think it's the method of valuing the NCI. One at proportionate proportionate share, the proportionate share, and the second one is at fair value of assets and liabilities.
A is proportionate share.
Yes. B is fair value.
And B is what?
Fair value.
Fair what? Value. At the date of what? Acquisition. Okay? That's what it means. We'll come to that. What is investment of Pali in Susie? Information here shows what? 200. I'm putting it side by side to see the options, the impact it makes. Now, option A, let's say is X, option B, let's say is what? Y. Now, IFRS says, don't just pick the carry amount, pick the fair value of the identifiable net worth assets of the subsidiary as at the date of what? Acquisition. And that is made up of share capital. What's our share capital? 120. And pre-acquisition reserve. What's our pre-acquisition reserve? We are still at the date of acquisition, which means the entire 60 is pre-acquisition reserve. But this 60, if you remember analysis we did here, failed to incorporate this fair value adjustment. Therefore, it means if we take this 60 and put it here, we sum it up and gives 180. This 180, though, represent the net asset of the subsidiary as at acquisition, but it only represents the book value of the net assets at the date of acquisition. Rather, what we need is the fair value of the net assets as at the date of what? Acquisition. Now, what is the gap between book value and fair value? Who can explain? What is the difference between book value and fair value in this case? Who can answer that? Who can answer that?
Okay, if I can just try, since we are already aware that the fair value of the plant is, I think, 200, there's a difference of 20 million naira between the fair value and the carrying amount of the asset. So automatically the gap between the fair value and the book value will be 20 million naira.
Okay. Now, what that means the difference here is a fair value adjustment. Of how much? Positive 20. Who can tell me why is it positive 20?
Yeah, because the value of the assets has appreciated.
Thank you. Okay, what that means that invariably, my fair value is now 200 instead of 180. Now, what is proportionate share? A, the proportionate share of the identifiable net worth assets as at the date of what? Acquisition will be stake NCIs in the subsidiary multiplied by subsidiaries net worth assets at the date of what? Acquisition that is measured at fair value, which is in this case, subsidiary has what stake? 20%. It is 20% of 200. And this gives us what? 40 million. If that is 40 million, it means I'll replace X by 40. And that gives me 240. All things being equal, this goodwill will be 40 million. Who can remind us what form of goodwill is this? Is it partial goodwill or full goodwill, and why?
Okay, I think this is a partial goodwill because the goodwill is only attributed to the parents of the subsidiary and not to the ACI.
Okay, who else? Who else?
Yes, it is partial goodwill because it is only recognized. It's recognized only parents, portion of the goodwill.
Okay. Now, let's look at B. B says fair value. Of the shares held by who? By NCI in SUSI as at the date of acquisition. And that means it is the number of shares NCI has in SUSI multiplied by the market price per share. Now, one thing is given to us on a platter of gold, the market price. Yeah, the market price was given to us at 2 naira per share. But in the question, I think they did not give us the number of shares. But in the same question, we are aware that the share capital is 120 million, whereas the nominal price is 1 naira per share. Therefore, we can simply say, since you have the knowledge of this, to say the number of shares of SUSI is the ratio of the share capital to the nominal price. What is the share capital? 120 million. The nominal price is 1 naira per share. Hence, I can say the total number of shares is 120 million shares, of which number of shares in SUSI that belongs to NCI is a fraction of 20%. If you recall, the stake of NCI is 20%. And 20% of number of shares of SUSI, which means 20% of 120 million shares should equal to 24 million shares. If I bring 24 million shares here, automatically what I get is 48 million naira. And that is what I can substitute here and say my Y is 48, which give me what? 248. And therefore, since we said this is partial goodwill, automatically this is what? Full goodwill. Okay, now this is the principle we want to test. Does it make sense to anyone?
Yes, sir.
Okay, now can we reflect our balance sheet? Let me try and copy balance sheet somewhere in our format notes. Okay. Let me clean it up. Okay. Let me go back and copy the question side by side. Okay. Now we go back. The name of the group belongs to Pali. Pali Group. What is our plant? 300 and 130. That gives us 430. What's our goodwill? Investment cancel out our goodwill. Okay, there's A and B. Okay. This is A. This is B. Our goodwill for A is 40, partial, B is 48. And that gives us 470 and 478. Current assets, we have 120 and 70. That's 190 apiece. What's our total assets? 660 and 650, 668. Share capital, Pali. That is 400. Reserves, consolidated. Okay, we have not consolidated any reserve because we are still at date of acquisition. Therefore, I'll change that to Pali. Alone. And that is 140. That gives me 540, which is equity attributable to Pali. What is NCI? NCI at various spots, 40 and 48. $40 and $48. This gives me total equity of 580 and 588. Now, what's the acquiring liabilities? Our current liabilities is 80 and 20. What do you have? 100. 680, 688. Now, who can tell me what is wrong? If you check that our total asset is 660, whereas our total equity and liability is 680. Here is 668, here is 688. Who can tell me what went wrong? Who can answer that?
Okay, I think it's because we are here to factor in the fair value adjustments to the value of the assets.
Okay, thank you. Now, if you look up here, I kept a space here. And the space is to recognize that we had fair value adjustment. What form of accounting entry are we supposed to have passed? When you fair value asset upward, the first thing is to recognize increase in the value of the assets, which invariably will affect our group assets. In this case, it's plant. And a corresponding credit will affect the reserve, which in this case affected our pre-acquisition reserve. All in all, it is by 20 million. Now, we have only taken recognition of the credit, which is what happened here. Which is what happened here. Sorry, let me try and. This is skewed towards this side. I don't know why. Okay. Now, this 20 million is a credit that we recognize. Why the debit was not recognized in our balance sheet here. Therefore, what do? We come down here to recognize the debit, which is an increase in the value of our asset. By how much? By that 20. Invariably, what do we have here? What we have here will no longer be I don't know why it's skewing towards the edge. Okay, what we have here will now be $450. Is it 450? That's 450. 300. That's 450. And therefore, this is not 70. It will be $490, $498, and this will be $680. This will be 6 what? 88. Therefore, we are at the same level. Does that make sense now? Does that make sense now? And
Yes.
therefore, this is how we reflect fair value adjustment in compliance with the requirement of IFRS 3. If these adjustments have been such that it's not only plant that has been affected, we will sum up all of the adjustments and it will affect pre-acquisition reserve. But in the balance sheet, each adjustment will affect the component of assets and liabilities they belong to. Similarly, in the way we have adjusted for property, plant, and equipment. Any other question before we move forward? Any other question before we move forward? Any other adjustments? Any other adjustment before we move forward? Questions? Okay. In the absence of that, I will give you this task. I will move up from there. Now, the next question I want to solve, we address what will be the post-acquisition effect of this adjustment we have made as at acquisition. And that will speak to scenario C. I want you guys to discuss it in group. For the next 10 minutes. And we'll come up with manner to which we can jointly solve the problem. Which means your discussion is to identify the problem. I'll move forward from there. Okay.
Please increase the font.
I think I've done that. I want you to pay attention to detail. I repeat, I want you to pay what? Attention to detail. On this premise, I'll divide you guys into groups. And before that, let me share this with you. I'll share it on this, you can download it, and I'll also share it on your WhatsApp page. You can pick it up. I've sent it to this, and I'm also trying to put it on the chat. You can download it on the chat. I want to put it on your WhatsApp page also. I want somebody to read as you download. Can somebody read it up? Madam Grace, can you assist us to read it?
Scenario C. The effect of fair value adjustments on the subsidiary's net assets acquired can be considered subsequent to acquisition, where the subsidiary did not reflect fair value adjustment in its financial statement upon its acquisition by the parent company. The illustrations below will be adopted in showing the subsequent effect of the fair value adjustments on the consolidated financial statements at a reporting date subsequent to the acquisition date. Illustration 3. Pali PLC acquired 80% of the equity share capital of Suzy PLC on the reporting date 31st December 2013. At the date of acquisition, the fair value of Suzy PLC plant was 170 million, when the remaining economic life of the plant is 10 years. Whereas the carrying amount, in bracket, the book value of other assets and liabilities equal the fair value upon acquisition. At the date of the acquisition, the subsidiaries retained earnings were 40 million. The statement of financial position of the two companies on the reporting date 31st December 2015 stood as follows. Statement of financial position as at 31st December 2015 for Ali and Suzy respectively. The figures are in millions. Plants for Pali is 300 million and Suzy 120 million. Investment in Suzy PLC under Pali 160 million. Current assets for Pali 120 million and for Suzy 80 million, giving the total assets of 580 million for Pali and 200 million for Suzy. Share capital and reserves. Equity share capital at ₦1 per share. For Pali, 400 million, and for Suzy, 120 million. Reserves, retained earnings, 100 million for Pali and 60 million for Suzy, giving total equity of 500 million for Pali and 180 million for Suzy. Current liabilities, for Pali, 80 million, and Suzy, 80 million. The total liability is 580 million for Pali and 200 million for Suzy. Assuming the prevailing market price of Suzy's share prior to the date of acquisition is ₦2 per share.
Okay,
Quiet.
I'm going
Can
to
you
open.
scroll down, sir?
No, that's all. Your requirement is now to prepare the statement of consolidated statement of financial position. I'll give you this time to discuss with one another and positively engage. Therefore, the room will be open in less than 10 seconds. Check your WhatsApp. I've also sent it to you, and it's also on your chat room, on your chat. Okay, welcome back. I want somebody to read this question before we forge ahead in solving it. Enaro, kindly read.
Okay, illustration 3. Pali PLC acquired 80% of the equity share capital of Suzy PLC on the reporting date 31st December 2013. At the date of acquisition, the fair value of Suzy PLC plant was 170 million, when the remaining economic life of the plant is 10 years, whereas the carrying amount, the book value of the other assets and liabilities, equal the fair value upon acquisition. At the date of acquisition, the subsidiary retained earnings were 40 million. The statement of financial position of the two companies on the reporting date at the 1st December 2015 stood as follows. Statement of financial position as at the 1st December 2015. Pali, Suzy, all in millions. Plant, Pali 300, Suzy 120. Investment in Suzy PLC 160. Current assets, Pali 120, Suzy 80. Total 580 for Pali, 200 for Suzy. Share capital and reserves. Equity share capital at £1 per share. Pali 400, Suzy 120. Retain reserves, retain earnings 100 for Pali, 60 for Suzy. Total equity and reserves 500 for Pali, 180 for Suzy. Current liabilities, Pali 80, Suzy 20. Total equity and liabilities, Pali 580, Suzy 200. Assuming the prevailing market price of Suzy shares prior to the date of acquisition is £2 per share.
Okay. Thank you very much. Now, I've emphasized something here by saying that the objective of this question is to expose us to how we can understand and appreciate what you need to do immediately after acquisition with respect to adjustment you've made at acquisition. And what adjustment are we emphasizing? Fair value adjustments. Now, some assets that are fair value, subsequent to acquisition may have been sold. And if they are not sold, at least they will have been subjected to depreciation, especially with respect to depreciable assets, items of property, plant, and equipment, intangible assets, and for investment property that is carried at cost. The question then is, the fair value adjustment you are talking about as at acquisition, is it an adjustment that will invariably affect the books of the subsidiary? The answer is no. Rather, it's an adjustment that is required only to be carried out from the group perspective, which then implies that the subsidiary asset will still be carried at what it is in its book, even though at group level, we've carried out some adjustments. What that creates is that at every reporting date, when we check the books of the subsidiary, it's not still reflecting the item that have been fair value, because that fair value adjustment is only done at group level, which is at consolidated level, not at the financial statement level of the subsidiary. Therefore, it brings about differences in amount of depreciation that ought to have been charged, which is now described as resulting in excess depreciation or shortfall in depreciation, which some people call over depreciation or under depreciation of the subsidiary's assets as a result of the fair value adjustment. Now, on that premise, who can identify critical issues that serve as a bottleneck in this question? The floor is open.
Okay, I think for me, the issue is the fair value. You said the fair value adjustment. That's an issue that will actually affect how to consolidate, and also for me, another thing I need to look at is that the plant 10 years. That's quite confusing. 10 years, there was no other information apart from the fact that the remaining economic life of the plant is 10 years. Doesn't mean that adjustment will have to be depreciated. That fair value gain will still have to be depreciated. That is what I did understand there. And also, in calculating the NCI, the reserve for the NCI for a date of consolidation for NCI, we're going to take. Does the NCI have a share of the fair value gain? That is what. Does it have a share of the fair value gain as a date of acquisition? Because it has a share in the retained earnings. So that's what. Those are the issues I have with the question.
Okay, thank you. Any other question?
Okay, my major issue is that the fair value as of the date of acquisition is given to be 170, but we have no inkling about the carrying amount as of the date of acquisition, upon which we have to charge depreciation over the next 10 years. So we had problem determining what exactly is the carrying amount as of the date of acquisition, and how exactly to go about it, whether to use this 120 and then work backward, adding the, so that's just the problem. I couldn't understand exactly what the carrying amount is as of the date of acquisition of the assets.
Okay, thank you. When I combine everything, you guys have seriously identified the problem. And one of the key things for us as finance professionals is ability to identify problems. And secondly, ability to provide sustainable solutions to that problem. Now, the main problem here is this. It's not the issue of the fair value, but the issue that we are not given on the platter of good because we don't have access to the financial statement of the subsidiary as at the date of acquisition that will have clearly show us the carrying amount of the asset as at 2013. Rather, the balance sheet given to us is of the subsidiary as at 31st December 2015, 2 years after. And although they've identified that all of the assets and liabilities have the carrying amount and fair value the same, except for plants. But the challenge we have is that the value of the plant we have today is the value 2 years after, which means that no matter what it is, the value can never be the same as what it was as at 2013. The question then is, how do I harness my knowledge and understanding of accounting for property, plant, and equipment under IAS 16 in trying to solve the problem by working back to identify what will have been my carrying amount as at 31st of December 2013 for my plants. Now, one thing you need to know as a professional is that information can be given on a platter of gold. And most times, information is not given a la carte. You use what we call a mosaic theory to filter skeletal information to be able to make it a whole for the purpose of having better insight on what to do. What has happened in this case? I read it again. As at the date of acquisition, the fair value of Susie's plant was 170 million. No problem about that. And they make us know that when this acquisition took place, and when the plant was fair value at 170, the remaining life of that plant still requires 10 years. But the carrying amount was not known for that particular asset. The question then is, can we know the carrying amount of that asset? The first thing we ask ourselves is this. The first question we ask ourselves is this. What class of assets is a plant? Who can answer that? Is an item of PP what? E. And furthermore, within PPE, not all PPE are depreciable, but in the knowledge you have, a plant is a depreciable what? PPE. If that is the case, what then is useful life as at date of acquisition? The simple answer there is that as at date of acquisition till the asset will be fully retired, it has 10 years remaining. Now, let me use a timeline as a guide. let's say this is the date of acquisition, 31st December 2013. And we are told that as at that date, the useful life of the assets remaining is 10 years. If that is the case, from this period to this period is 10 years to go. Now, if you add 10 years to 2013, it means the date of asset retirement, when the asset will have outused its useful life, will have been 31st December 2023. Okay. Okay, as we were saying earlier, is that this is my date of acquisition, 31st December 2013, and this is my date of asset retirement, 10 years after, 31st December 2023. In between these two dates is my reporting date, which is today, 2 years after, date of consolidation. Now, my date of consolidation, which is my reporting date, is 31st December 2015. And how do we define this date? This is 2 years after acquisition, when the asset is already used up. Why this is remaining life 8 years, that is remaining as of today. Now, today, the asset is 120 million. Yesterday, which is date of acquisition, the value of the asset is unknown, X. And who can tell me, as at the asset retirement, what will be the value of the asset here? You know, there are 3 points we have. Point 1 is the date of acquisition. Point 2 is the current reporting date. While point 3 is the date of asset retirement, which is in the future. What will be our value at point 3? Given that at point 1, it is X. Point 2, it is 120 million. And point 3 is what? Who can answer that?
Okay, sir. Since the question did not specify that there is a residual value, so we assume that the value of the assets as at the date of retirement should be 0.
Now, it should be residual value, as you have said. And if we have the residual value, that will be the amount. But since there's no residual value, it is presumed that the asset has no scrap value, and which means it is 0. And that answers the question. If that is the case, there's one critical assumption we need to make. What is the assumption? The assumption is that depreciation is on a straight line. Do we all agree?
Yes,
if it's on a straight line, what it simply means is that this 120 million, hence 120 million naira represents the carrying amount less residual value. That is 120 million, which is this, minus 0, gives us the depreciable amount over the remaining 8 years as at the reporting date. What is the reporting date? 31st December 2015. Which means this 120 million represents the carrying amount. This 0 represents the residual value. The difference between them is the amount that will be depreciated over the remaining 8 years. Therefore, we can continue to say, if that is the case, the annual depreciation will be assumed to be the 120 million over the remaining 8 years, which is equivalent of depreciable cost over remaining useful life. How much is that? From my calculator, that should give me 15 million naira. Any question at this point? Okay, if there's no question, we'll move on. What it then means is that this 120 will be depreciated at the rate of 50 million naira per year for the next 8 years to get to 0. Now, what we are interested in is this point. How much has been depreciated in the last 2 years? The amount depreciated in the last 2 years is equal to the 2-year depreciation, which is between 2014 and 2015, is equal to 2 years multiplied by 15 million per year, which gives 30 million naira. Which means here, what we have is 30 million naira. Thereby, by working back from 120 to this, shows that all things being equal, the carrying amount of the plant as at 31st December 2013 will have been 120 million, add back what was depreciated out of it, 30 million. And that gives us 150 million. Therefore, which means X should be 150 million. Any question at that point? X should be 150 million. If that is the case, alternatively, we can equally ascertain that alternative method means that we can use word problem to say 120 million naira represents a fraction of 8 years out of the original 10 years of the assets. of the sum of X. The question then is, what is X? What is X is to take X as the subject of the formula. And what is that? It means 120 million times 10 years is equal to 8 years times X. Therefore, what is X is simply 120 million times 10 years all over what? 8 years. And that gives me what? 150 million. Which means regardless of the case, whether you use this kind of methodology or use the shortcut, once you understand the principle, the answer remains what? The same. Therefore, what it simply means is that what was missing from the question is that the examiner, if they really like us, will have given to us that when the fair value was 150, the carrying amount, when the fair value was 170, the carrying amount was 150 million as the carrying amount. If we have this information earlier, we won't bother to have carried out this work back. But since we don't have it on the platter of gold, and it is not given to us a la carte, we use our knowledge with respect to IAS 16, accounting for property, plant, and equipment, to solve the problem, which is what we've done. And that is that. Any question on this? Do we need further clarification? Any question on this? Any question on this? I can't hear anyone.
Hello, I think your explanation is very clear. At this point, I don't think there should be questions for now.
Okay. Thank you in that regard. Therefore, let's move on. Now, we can now start the session. The first thing is, what is the structure of the group? Pali and Susie. What's the stake? 80%. NCI is 20%. Date of acquisition, 31st December 2013, and we are reporting 31st December 2015. This is 2 years apart. Susie's reserve. As at 31st December 2015. From our information in the question, the reserve stood at 60 million. which you need to split into pre and post. What is pre-acquisition profit? From our information from the question, as at the time we took over the company, the retained earnings to that 40 million. And we've grown that profit by additional 20 million over the last 2 years to arrive at post-acquisition profit. We are told to carry out fair value adjustments. And of all of the adjustments, only one impacts our books, which is the fair value adjustment of plant. Why? Because all other assets and liabilities have the kind amount and approximation of the fair value. Therefore, what is the fair value? The fair value of the plant was 170 from our question, while the carrying amount was 150. And this 150 came from where? Let me try and trace it. The 150 came from here, which is the same 150 here, depending on the method we use. And that is how we got that 150. Therefore, we have fair value increase in the value of an asset by 20, which is positive fair value gain. And what would be our accounting entry for that? Our accounting entry for that is to recognize an increase in the group assets. PP, in this case, plants, and recognize increase in our pre-acquisition reserve, which is 20 million naira. This is similar to what we've done before. Now, how does this affect our measurement of goodwill? Goodwill. We have two options, A and B. Cost of business combination. Pali's investment in Suzy. How much is the investment? 160 million. NCI, we have A and we have B. We'll come back to that, but for now we'll call it X and what? Y as a known variable. We need the fair value of Suzy's net assets as at the date of acquisition. That comprises the share capital. What's the share capital? 120. And pre-acquisition reserve. What's our pre-acquisition reserve? It's 20. Oh, sorry?
40.
Pre-acquisition reserve is 40. Therefore, this will have given us 160, but this 160 is the book value of the net assets. But rather, we need to carry out fair value adjustments. In this case, is only for plant. And by our accounting entry, we are to increase the value of our reserve because it's an upward measurement. And that gives us 180. Now, what is our NCI based on proportionate share? It's 20% stake of the 180 million, which in this case will be 36. And this gives us 196, which means our goodwill here is 16. Second case is to fair value, and our fair value per unit of share is 2 naira. And we need to multiply this by the number of shares held by NCI, which we can obtain by, first of all, determining the number of shares in SUSI, which is obtained by dividing the share capital of 120 million naira by 1 naira nominal price per share. That gives us the number of shares multiplied by 20% stake of NCI, which means 120 million shares multiplied by 20 give us 24 million shares. That 24 million shares is priced at 2 naira per one, which gives us what? 48. And that's how we obtain that, which means both 36 and 48 are derived. Let me put it in red. On that premise, we obtain 208 when it is measured at fair value, and the difference is 28. And that gives us the full goodwill. Remember, this first goodwill is partial. This second goodwill is what? Full, and is a function of the accounting policy we have adopted. Now, what is critical to us is to go back here. Who can tell me the subsequent effect of this fair value adjustments we have made on the group account subsequent to acquisition? Who can answer that? What will be the effect of this fair value adjustment we made on plant, which is a depreciable asset? What will happen to it? Over to you guys. Shegun, I think you want to say something.
Okay. The effect of the fair value gain is that since we've passed the credits entry to pre-acquisition reserve, then the debit entry will increase the value of the assets. So it means we are going to debit the group PPE, and it will increase the value. So that is the effect.
I didn't get your message clearly, sir.
Okay, what I'm trying to say now is that the credit entry had already gone to pre-acquisition retained earnings. So the debit entry will go to the group PPE. So it will increase the value of the PPE by 20 million naira.
And thereafter?
Sorry. So, and thereafter, I think we continue carrying it at that value subject to further depreciation.
Okay. Okay. No problem. Now, what if you remember when we started, I discussed about the fact that even though you have made an adjustment to the carrying amount of the subsidiaries asset, it still does not reflect in the subsidiaries book because it is a group adjustment. is an adjustment only required for consolidation purposes. Which then means that at every point in time, the books of the subsidiary is reflecting what the value of the asset is prior to fair value adjustment. Therefore, the depreciation that will be charged by the subsidiary year in, year out will be different from the depreciation that should be charged at the group level. Invariably, what then happens is that we need to take cognizance of that and carry out depreciation adjustment at every reporting date up to the point the asset at use is useful life or the asset is disposed of. In this case, the asset still continue to make use of its useful life. That adjustment will be required all through the life of that asset until that adjustment regarding fair value has been totally charged against profit or loss. Therefore, what does that trigger? What it triggers in this sense is for me to carry out depreciation adjustment. What is depreciation adjustment? There are two methodologies I'm going to use. Method A is that I will compare what is the depreciation which is based on the fair value with the depreciation that is based on carrying amount. Remember, fair value is at group level. Carrying amount is at the company level. Therefore, what is it? Depreciation based on fair value would be the fair value of the asset was 170 million as at acquisition. And the remaining life then was 10 years. If we have reflected this in the books of the subsidiary at company level, it means the subsidiary would have been depreciating the plant at the rate of 17 million naira per year. And for the 2 years that have gone, remember 2 years, where is 2 years coming from? These 2 years that has been used up, it means 70 million will have been the charge in 2014 and 70 million will have been the charge in 2015. In 2 years now, 70 million in 2 years is equivalent to 34 million. But what do we have in the books of the subsidiary at the company level? The asset is carried in his book as 150 million. The same 10 years, it means the company is charging 50 million naira per year, which is the same thing we have here as reflected here, that make up 30 million for 2 years. Remember the 50 million. That's what it means. Therefore, what happened is that 50 million was charged in 2014 and 15 million was charged in 2015, which means in 2 years, what they charge is 30. And this 30 is the same 30 we showed there. Now, what has happened? It means if you compare it, we are not charging the same amount of depreciation, which brings about difference of 4 million. This 4 million is what we call depreciation adjustments. And it could be excess depreciation adjustment or shortfall. In this case, it is shortfall because you have under depreciated, which means this depreciation adjustment here, I can call it under depreciation. Now, who can tell me the implication in your profit or loss if you under depreciate an asset? If you have under depreciated an asset, what will have been the effect?
We have overstated profit or overstated retained earning.
And if you are to correct it, what do? Is to go back and charge that depreciation, which means the accounting entry here is to debit the subsidiaries' profits, which has been overstated. But the subsidiary profit belongs to the parent and what? NCI. Which I mean, invariably, what we are doing is that this debit is a charge to the parent to the tune of 80% of the stake it has. And it's also a charge to what? NCI to the tune of what? 20%. Why? Because both parties are the beneficiary of the profit of the subsidiary, which means anything that affects the profit of the subsidiary, in most respects, will affect the shareholders of the subsidiaries. And who are the shareholders of the subsidiary? The parents and the NCI, which means 80% of this of 4 million naira will give me 3.2 million naira. And 20% of it will give me 800,000 naira, which is 0.8 million naira. Now, where is the credit going to? The credit is to adjust for the overstatement of the carrying amount of the assets. Because when you under depreciate an asset, not only that it will overstate your profit, but it will also overstate the carrying amount of your assets. Therefore, to reflect the true carrying amount is to reduce it by the amount of overstatement, which means credit the subsidiaries plans, which invariably is closed out to the group plans because it will be consolidated. By how much? By the total amount, which is 4 million. Remember, this 3.2 and 0.8 make up this 4 million as you have it in the books. Okay, that is that. Any other question? Therefore, this is what we are going to reflect as an adjustment. But remember, I told you that this is method A. Can we look at method B? What is the alternative method that we can use to determine this depreciation adjustment? Method B.
If I would say for method B,
is to say,
okay.
I can't hear you.
Just looking at the difference in that is the 20 million as a lump sum, 20
Now,
million value.
Then, yeah, let us look at method B. Method B is saying that there are common factors between the depreciation that is based on fair value and depreciation that is based on carrying amount. What are the common factors? One, the useful life is 10 years apiece. Two, the used life from acquisition date, 2 years apiece. Now, what is the difference? The difference can be attributed only to the fact that the fair value amount of 170 is different from the carrying amount of 150. Therefore, we can summarize it and say the 2-year depreciation adjustment is saying 2, which is a common factor, 10, which is a common factor, is brought out. Remember, 2 years out of 10, 2 years out of 10, that's what it means here. Of the difference between these two, between the fair value, which is 170 million, and the carrying amount, which is 150 million, which means the difference of 20 million. Who can tell me where we found this 20 million? Where is it coming from? This 20 million is coming from the adjustment we did there, comparing 170 and 150. That is it. Which means if you know this, it means very straightforward, we're able to obtain the same 4 million we got the other time, which is this 4 million here, instead of going through a long route. But this method B is only appreciated when you understand the basic principle, which is displayed by method A. Which means one thing is to have knowledge, which is method A. And one thing is to be smart with the knowledge you have by trying to find a way to efficiently, more or less, utilize your knowledge. The same thing technology is doing now. Nothing technology is doing now that we can't do before, but now with technology, we can do it more efficiently and with lower cost. That's what we mean. And that is the smartness there. Okay, any question at this point?
Okay, sorry, I have a question.
Yes.
I actually understand the explanation, but I want to understand what will be the presentation if all things being equal. If the acquisition is during the year, will there be any effects of depreciation on fair value adjustments?
No, fair value adjustment is as at the date of acquisition. Therefore, depreciation will not affect it other than what has been depreciated before you obtain the kind amount as at the date of acquisition. Do you get what I'm saying now? Subsequent depreciation will be treated the same way we are treating this depreciation adjustment, which means you have to prorate depreciation for the half year for the purpose of adjustment you want to make if it has not been done before. Do you get what I'm saying now? One thing that is critical is once you understand the principle of when you are dealing with something half of the year, what kind of adjustment you require is subject to the time proportion that you have made use of. Do you get what I'm saying now? There's no fast rule to anything other than at every point in time, your understanding of the principle is what you apply to every situation, and that's how you solve problems.
Thank you.
Any other question? Any other question? Any other question? I can't hear anybody. Madam Grace? Madam Oladokun?
Question, sir. It's
Okay. Tomilayo. And now.
I think you answered my question when you talked about the sharing of the fair value,
Okay.
fair value gain and the yes.
Okay, thank you. Now let's now determine the NCI. Okay. What is the value of my NCI? NCI as at the reporting what? Date. I have option A and option B, all figures in million of naira. What is the value of NCI as at acquisition date? We have it here, 36 and 48. What is the share of post-acquisition profits? That is 20%. 20% of what? 20 million. Can we remember 20 million? Our post-acquisition profit. That gave us 4 million. Now the adjustment that affects it is this adjustment of 800,000 being additional depreciation that affect the share of profits of NCI in the subsidiary, which means less SS, no, okay, not SS, additional depreciation, less additional depreciation of plants, 800,000, 4.8 million. What is the value of our NCI as at reporting date, 2015? My calculator please confirm the figure to 36 plus 4 minus 0.8. That gives me 39.2. 48 plus 4 minus 0.8. That gives me 51.2. Okay. Let me do that of consolidated reserve. As at 31 December 2015, I have A and I have what? B, all figures in million of naira. Palace reserve or Palace retained earnings. From our question, it is 100. Share or post-acquisition profits. That's 80% of 20 million. I believe you can remember the 20 million from our analysis here. Let me highlight it. This 20 million. Let me highlight it here also so that I can see the link. That gives me 16 million. And don't forget, there is additional depreciation that need to be charged for that depreciating the plant based on remeasurement at fair value. What is the adjustment we require there? We require a charge of 80%, which gives us 3.2 million out of the 4 million. Remember, 80% of what we charge, that's why it's 3.2 a piece. Whereas for NCI, what we charge is 20%. Okay. Can we sum this up? All things being equal. What do we have? 100 plus 16 minus 3.2. That gives me 112.8 a piece. Any question on that? If there's no question, Let me now copy a balance sheet. Let me copy this balance sheet. And bring it down here. This is how we can be smart also. Okay, in my balance sheet, let me clean those areas that require, okay, I shouldn't have cleaned that. Okay. Okay. All things being equal. The balance sheet belongs to Pali as at 31st December 2015. Okay, PPE. What's our PPE? Our PPE is 300 and 120. Okay. Can you start to copy it here? So that this is closer to us. 200, 300 and 120. But we can recall that there was an adjustment here which requires us to recognize additional 20, which is supported by this accounting entry, debit group PPE. Doing so means I have to add 20 to it. And there's also an adjustment that told us that there was under depreciation where we need to charge more depreciation of 4 million on the PPE for the subsidiary, which is also component part of PPE of the group. Invariably, this will be 300 plus 120 plus 20 minus 4. And that gives us 436. Goodwill. Our goodwill was 16, partial, and full 28. If I add it together, 436 plus 16 will give me 452. 436 plus 28 will give me 464. Current assets. Our current asset is 120 and 80. I come here, 120 and 80. That gives me 200. That is 652 and 664. All things being equal. Now, what is my share capital? Is for Pali. And my share capital is 400. My reserve is consolidated. And consolidated here is 112, 112 apiece. And that gives me 512.8, all things being equal. My NCI, one is 39.2 and one is 51.2. 39.2, 51.2. What is my total equity? 512.8 plus 39.2. That gives me 552. 512.8 plus 51.2 give me 564. My current liabilities, 80 and 20. That's 100. That gives me 652 and 664. And that brings us to the end of adjustment regarding fair value, both at the point of acquisition and subsequent to acquisition. Any other question at this point? Any question at this point? Any question at this point? Shegun?
Yes, sir.
Any question at this point? Nuruddin?
It's very clear to me.
Miriam, Jide, Enaro?
No question.
Okay.
It's clear.
Okay, let me now see if I can give you practice question that you can go and play with, that deals with such questions on pre-acquisition reserve, on fair value adjustments. Okay, I found a question I'll give to you, and I wish you do that between today before tomorrow. Okay, I'm trying to pick up the question and I'm going to put it up now. Assignment/homework. We'll read the question together before we call it a day. Okay, can somebody read it? Okay, can somebody read that?
P&Co acquired 75% of the ordinary shares of S Company on the 1st of September 2015. At that date, the fair value of S Company's non-current assets was 23,000 naira, 20,000 naira greater than their carrying amount. The balance of retained earnings was 21,000 naira. The fair value of the non-current asset does not affect the tax base of the assets. The relevant tax rate is 20%. The statements of financial position of both companies at 31 August 2016 are given below. S Company has not incorporated any revaluation in its books of accounts. NCI is valued at full fair value, which was deemed to be 18,000 at the acquisition date. Statement of financial position as at 31st August 2016. All this. If S Company had revalued its non-current assets as at 1st of September 2015, an addition of 3,000 naira would have been made to the depreciation charge for 2015/2016. Required, prepare P Company's consolidated statement of financial position as at 31 August 2016.
Okay.
Yeah.
Now, I believe this question also speaks little of our discussion so far. Therefore, I'll leave it to you for you to attempt. I'm going to send it to the chat room now and also to the WhatsApp group for you guys to make use of. Okay. Any other question before we wrap it up? Any question before we wrap it up? Okay, you can pick the notes from the chat box, and I'm also sending it to our WhatsApp page for you to pick and try to solve the assignments. And you can see how wonderfully they performed. And that has a nature of boosting confidence in practice or even in any place you find yourself, whether examination or otherwise, or even in discussions with professionals alike. Any other question? In the absence of no question, thank you very much for today's lecture.
Hello, Disabiwa.
Yeah.
Sorry, just a minute. Before you go, you mentioned the tax rate in this question here, please. Can you just explain how the tax rate affected before we start solving it? Because it's a little bit, we didn't talk about tax rates, the other ones we solved. Yeah,
Okay.
before we start.
If you remember, we discussed something when we did income taxes. Have you forgotten?
Okay.
Where we start to look at deferred tax implication of things arising from business combination. And if you could remember, I mentioned then that when we get to business combination and every other topics like financial instrument and etc., we start to use the knowledge of the deferred tax we've discussed to apply to those transactions that give rise to deferred taxes. Have you forgotten?
Okay, yeah, you said something like
Exactly. Let us go back to those videos. You understand? We've said something that we are professionals and we are not just learning just to learn. We are learning for the purpose of applying. And now the application has come. You can see where the deferred tax play a role in group adjustments. Okay, what you do is that between today and next week, you are going to marry your knowledge of deferred taxes and your knowledge of business combination and adjustment we've done today, and see how do you solve business combination problem with respect to fair value adjustment, and equally the impact that deferred tax has on such adjustments.
Okay.
Yeah, thank you very much, sir.
Okay, you're welcome.
I'll be willing for everybody to attempt this question and present their own position by next week. By God's grace, it will be encouraging.
Okay, it's not tomorrow.
Because of the deferred tax there, and because of the question you asked, by the sample I've taken, which means you are the sample, you have more or less represented the population or the larger population. Okay, only that others ask the question internally, but you are confident enough to ask it externally, which means you are speaking on behalf of others. Therefore, I'll give you the allowance till next week.
Okay, thank you.
Yes. Take care. Good night.